to Business Training's Certified Investment Banking Associate Program, video module number 2. In this video, we're going to look at financial statements. A company's financial statements show a reader how money is earned, spent, and how much is left over. The SEC said if you can read a nutrition label or a baseball box score, you can learn to read basic financial statements. The 3 main statements used by investment bankers and accountants and companies are the income statement, the balance sheet, and the cash flow statement. And they're all interrelated, and we're going to go into that next. The income statement is a record of how much a company took in and paid out over a period of time. It starts with a top line, also known as revenue or sales, and backs out various expenses, leaving a final line, also known as the bottom line, that shows net income. It's arranged like a set of stairs, with each step moving down being a deduction from top line revenue. The basic layout being revenue minus cost of goods, minus selling, general and admin costs, minus interest, minus taxes. And after all that, you've got net income. The balance sheet is a record of what a company owns and what it owes at a single point in time. And it's important to understand that it's a point in time rather than a period of time, where the income statement covers a period of time, usually a year or a quarter. Balance sheet is a snapshot at a particular date. The basic layout for the balance sheet is to start with assets, which include cash, accounts receivable, inventory, and physical properties, things like machinery, stores, office space if owned. And then the next section down is the liabilities, which includes payables to vendors, payables to the government, payables to employees, and debt. And the difference between assets and liabilities is the shareholder's equity. It's also called book value, usually presented on the balance sheet as assets, and then if you match the total asset number, it equals the liabilities plus equity, but it's also useful to know that equity is the difference between assets and liabilities. The final main statement used by investment bankers is the cash flow statement. Cash flow statement shows changes in cash balances over a period of time. Again, like an income statement, it covers a fixed period of time. The numbers on a cash flow statement can be derived from data on the income statement and the balance sheet. So if you're given an income statement and a balance sheet, you should be able to create a cash flow statement. The basic layout of the cash flow statement is to start with the beginning cash balance from the end of the prior period, add in cash from operations, usually equal to the bottom of the income statement line, and then subtract out cash used for investing and cash used on financing. And that gives an ending cash balance, which then flows to the top of the balance sheet. Quick overview just of the SEC filings that publicly traded companies are required to file periodically with the Securities and Exchange Commission. And these are a great source for investment bankers when they're researching companies, either companies that they're working with or comparable companies or companies they'd like to work with. You got to know which SEC statements to pull up and what information you're going to find in them. Included a little link here, but a website that's very useful is sec.gov, and then the company filing search within there. So a 10K is also called an annual report. It's got a full year of audited financial statements. It has a section called the MD&A, the Management Discussion and Analysis, wherein the management team discusses changes in financials year over year, explains why various margins may have changed, why growth rates have changed. And the 10K often has useful information about the business and its competitors. It's a great place to start when learning about a company. A 10Q is a quarterly report with information on year-to-date period as well. So for example, a company's third quarter 10Q will have data for the 3 months of that third quarter, but also for the 9-month period from the previous year end up through the end of that quarter. The financials in here are very useful. They're normally not audited financial statements, but are reliable for the purpose of valuation and looking at results. A form called an 8K, also known as a current report, is used by companies to spread news such as earnings announcements and M&A transactions. It's news of a material nature where the SEC says that they actually have to file something with that agency, letting people know about major announcements. kind of most useful for the earnings announcements on the M&A. Always worth checking to see if there's a current 8K out on a company that you're investigating. Next one on the list here is the proxy, which is also known as a 14A. This includes materials that are sent out before the annual shareholders meeting, and it may contain useful data on share ownership, as well as the name of comparable companies, because in the proxy, a company will have to gauge its stock performance versus that of its peers, and you can often see who a company considers to be its peers. Final SEC filing that I've laid out here is the S1. That's a registration statement, also known as a prospectus, most often associated with a public stock offering. S1s are filed in relation to IPOs and are very useful as they contain a really thorough business overview, more than you'd even get in a normal annual report. This is where a company lays out what it does, who it competes with, what the risk factors are for an investment, and basically what it expects to do in the market. Just one last note on this page is that bankers often have to compute what's called LTM, or last 12-month financials. And it's a pretty simple calculation, but it basically does, unless you're looking at a company's reports, the most recent reports being at the year end, if you're looking at anything after that, you may have to do a calculation where you're looking at the most recent 10Q and 10K to calculate a last 12 months, basically done by taking annual data, adding the most recent year-to-date data, and backing out the previous year's year-to-date data. It's time to talk about the relationship between financial statements. As I mentioned at the beginning of this module, income statement, balance sheet, cash flow statement are all interrelated, and changes on one do flow through to the others. It impacts the value in other statements. It's crucially important for investment bankers and students in this course to have an excellent grasp of the key relationship between the three financial statements. I've just laid out 3 examples here, and we're going to, in a second, flip over to our Excel file with data on the fictional data on Makeup Co. But let's just talk through a couple right here. A decrease in the gross margin, which is basically a change that happens on the income statement. All else equal, a decrease in gross margin, also known as an increase in a relative cost of goods, will flow through the income statement to lead to a decrease in net income. That lowered net income will lower the income from operations, basically usually the second line on the cash flow statement, thus lowering the ending cash balance on the cash flow, which then flows through to mean a lower cash balance on the balance sheet. And we'll see this in a second. Similarly, a change in inventory turns, which is a balance sheet change. If we decrease inventory turns, and for real clarity, I'm saying if we decrease turns from 12 times to 6 times, that basically means a company is going from holding 1 month of inventory to holding 2 months of inventory. So it's actually quite a meaningful change. Shouldn't have any effect on the income statement other than some things related to cash interest, but it has a great effect on the balance sheet and cash flow. Inventory value will double when your turns halve, and this basically means that the company had to lay out cash to buy a second month's worth of inventory. So that larger cash outflow on the cash flow statement will show up as cash paid out to double in the inventory. Finally, a final example is to think of an increase in capital expenditures, which is a cash flow statement change. All else equal, increasing capital expenditures will decrease the cash balance on the balance sheet because a company is laying out more money in the current period to purchase or invest in assets. In reality, you can make the argument that an increase in capital expenditures, also known as CapEx, should boost productivity, but it's unlikely that would be seen in the very, very near term. Time to flip over to our Excel financials. First thing I'd like you to do, if we open in the income statement, is just to hide some columns, and I've set up some buttons that have to do with the projections that we're going to get into in future modules. So I'm going to go ahead and click this little hide button on the income statement. Similarly, going to the balance sheet, clicking the hide button, and going finally to the cash flow statement and clicking that hide button. All right, back to the income statement. Let's just take a quick look down one of the columns. These are historical financials, again, fictional, for Makeup Co. But we could see it's had revenue growth, and I'm just making these numbers up. I started with 400 million. This cell up here tells you that the dollars are in millions. 400 million of revenue, and it's grown by 25% in the past 2 years, each year. Our cost of goods, if we look at the formula, is steady at 50% of revenue, which means that we have a gross margin of 50%, basically 1 minus the cost of goods. The selling, general, and admin, if we look in these formulas, we could see that's 25% of revenue. You can see that's tied to the revenue line, which leaves us with an EBITDA, or an earnings before interest, taxes, depreciation, and amortization of 25%. We basically started with 100%, took away 50% for cost of goods, and 25% for selling, general, and admin, also known as SG&A. So we're left with a 25% cash flow margin. Very nice for most businesses. Next line is depreciation. And if you look in those formulas, you can see it has to do with a value from the balance sheet. Let's just flick over to that value right now. And it says balance sheet F16. If we look at F16, that's called net PP&E, or property, plant, and equipment. Depreciation is an accounting concept having to do with tax law, whereby when companies invest in or purchase assets, they're not always allowed to expense the entire amount of that investment in 1 year. Companies would love to, say a company had $50 million of earnings, if they put $50 million into a new plant, they'd love to report to the government, hey, we've had 0 earnings, we owe 0 tax. And the government says, not so fast, you need to depreciate that over its useful life. And financial models you'll see, and in the MD&A, in financial statements will tell you the life over which things are depreciated. I've just kept it really simple here. If you look back at the assumptions page, and you'd see that the depreciation we're using is 5 years. We're going to get into some more complex depreciation concepts in future modules. But basically, on the income statement, showing up as the net PP&E divided by 5 years. So we had 50 million divided by 5 years. We have a $10 million depreciation in year 1. Likewise, you could see the future years. When we back out depreciation from EBITDA, we're left with EBIT. Again, a pretty nice margin, 22 plus, depending on the year. And next section down has the interest expenses. And if you look at this formula, you'll see that the interest is based on an average balance multiplied by an interest rate. So the average balance is the average between 2 years on the balance sheet. It's just a useful way to calculate interest, knowing that debt probably gets paid down over time, especially if there's a change in it. We've also got some interest income. Again, that's just an average of some cash balances multiplied by an interest rate, which we can find back on the assumptions page. But when we back interest away from EBIT, we're left with, I guess, what could be called EBT, more commonly known as earnings, pre-tax income. We've then got a tax rate applied, which you can see here is just an assumption of 35%. And that brings us to the bottom line, or net income, 13 and rising in future years because of depreciation wasn't quite growing the same way. Let's just walk through a column on the balance sheet as well. We look back historically, and we could see that this company has a healthy amount of cash. These are in millions, so 20 million of cash. Receivables, which are tied to the income statement, and we'll get into this on some future modules as well, but it's common to forecast receivables as some sort of days versus sales. So for example here, this divided by 12 basically says a company is getting paid. On average, it takes about a month for it to get paid from making its sales. Similarly, inventory is often based upon cost of goods and a turn. So in this case, we've got equals income statement F10, which you can see is the cost of goods, and a turn on that, which I put in as 4 times. Basically means a company is holding 3 months of inventory at any time. Next lines down, we total our current assets. Then we get the PP&E section, which we discussed already, but it's worth noting the changes to the net PP&E have to do with both additions to PP&E, which we're going to see, you can see from the formula here, come in from the cash flow, investing activities on the cash flow. And then that depreciation that's just adding in from the cumulatively from the income statement. All those total up to a total asset number. We then move down to the liabilities side. Payables, like receivables, are often tied to some sort of days to be, days on hand, days paid. So you can see in this case, we're assuming that we take 30 days or take 1 month to pay our vendors. Debt, I just made up some numbers here for Makeup Co, but let's assume that they started with a $120 million loan, and you'll see some activity on the cash flow statement. But basically, they paid down half of it in year 2, and by year 3, it was all gone. They did not draw on a line of credit. So simple, current liabilities plus debt is the total liabilities, and as we went through already, the difference between those all is the shareholders' equity, which is made up of both a number for common stock and then what's called retained earnings. Retained earnings, simply the cumulative total of net income that's been accrued over various years. And let's just flip over to the cash flow statement. As I mentioned, cash flow statement is really derived from changes on the income statement and balance sheet. Given that I didn't give us a bit more history, we need to start in year 2 because we didn't have anything prior to year 1 on which to do our calculations. But if we just go down from the top, we could see that cash flow is tied to the beginning cash, which we'll flip back to the balance sheet, and you see that the previous year's cash comes to the top of the cash flow. We're adding in net income from the income statement, which we can see in year 2, 72.7. We're adding back depreciation and amortization, and we talked about those earlier, but it's not really a cash expense. It's just an accounting expense, mandated, like I said, by tax rules. So that gets added back, and you can see that that matches the amount on the income statement. We're then adding, cash flow statement captures changes in this section, changes on the balance sheet. So an increase, for example, in accounts receivable, meaning that your clients, customers, the amount they owe you has actually gone up. While your sales may be increasing, if your accounts receivable go up, it's treated like a cash outflow because you've made sales and haven't received the cash for it. That's where we're getting a negative value here. Similarly with inventory, if inventory goes up, as you can see it going from here to here, that is essentially a cash outflow. You have to lay out cash to buy that inventory. For payables, we're actually moving in a nice direction for cash here. If our payables increase, it means we got services from our vendors, but we didn't lay out the cash for them yet. So when payables go up, you can see we have a cash inflow. And all those total up to the cash from operations section of the cash flow statement. And you can see I'm just highlighting the cells involved in that formula here. Next section would be cash from investments, cash for investing activities. I have just put in a formula that ties that value to revenue. It's reasonable to assume that as revenue grows, investments in property, investments in plant, investments in machinery would have to grow. So you can see there's just a formula here. And that change in PP&E flows to the balance sheet. If you look, we're going from 85 to 97.5. That difference is generated here on the cash flow statement. Next section on the cash flow statement is the investing activities. And as we mentioned earlier, we did have this company pay off $60 million of debt each year, and you can see that showing up as a $60 million outflow. When all of that is totaled, the cash from operating activities, cash from investments, cash from debt payments, we're left with an ending cash balance that simply flows to the top of the balance sheet. And it's key to always make sure that your balance sheet balances. I have a little formula down bottom for us to monitor, just making sure we've got dashes or zeros showing that it's balanced. Let's just look at those 3 changes that we talked about in the slideshow as examples of how things flow through. So, for example, if we look at a change in cost of goods or change in the gross margin, if we went from a 50% cost of goods, and we went up to 52. So just, what you'd think would be maybe a slight increase in your cost of goods, and so obviously it brought down your gross margin, it brought down our net income. But if we look at our balance sheet, we could see our cash is now 10 million for that year. Whereas if we undo that change, cash was 20 million. Basically a 50% change in the cash balance for a 2% change in our margin. So that just shows you how an income statement change can flow through and really affect the cash level on the balance sheet. Similarly, if we look at a change in inventory turns, again, let's keep in mind this, let's look at year 2 here, and we'll change the inventory formula. Instead of turning it 4 times, let's turn it 3.5 times. And did you see the cash go from, well, I think it was 14 million down to 5. Let's just undo that. Just again shows you how an inventory, maybe a small change in inventory turns affects not so much the income statement, but it is affecting the cash flow statement. And let's just highlight that. It's going to hit this decrease in inventory number, which is 12.5 now. And if we go back and redo our little change from 4 to 3.5 turns, 21 million spent to boost inventory. And if we undo that, again, it's back to that 12 million. Final change I wanted to highlight is a change in capital expenditures. Again, let's focus on this 1421 of cash. If we go to our cash flow, change our formula. So instead of spending 2.5% of sales on investments, let's put 3.5% one year. Well, our cash has gone down to 9 and 16. Major effect. So just kind of showing that changes made to one line item on any of the statements can have major effects on other statements. That's all for this module. Join us for Module 3 shortly.